company on KYC's radar today is Anand Rathi Wealth. And this is basis the kind of numbers that the company has reported in the second quarter. Now, first, let's quickly understand why are we going to talk to Anand Rathi and what is it that we at NDTV Profit and all the investors want to know. First up, the company has actually achieved more than 50% of the full year revenue and PAT guidance in just the first half of FY26. So will this lead to a revision for FY26 or not? And if the margins of 45-46% are sustainable going ahead. Second up, if you're talking about their FY26 guidance, is that going to be achievable? Because they've guided for 1 lakh crore AUM. So what is that going to look like? Which segments are going to be the growth drivers for the company in FY26? And the industry outlook when it comes to increased SIP flows and the kind of retail participation that they are going to keep as a check as well. So these are the key questions we're talking about. But first up, let's understand more about the company. Now, Anand Rathi was a company that was incorporated in 1995. Absolutely, they're AMFI registered mutual fund distributor, and they have a wide product portfolio of wealth solutions, financial products, and they're looking at distribution of those as well. In terms of the business verticals, private wealth, digital wealth segment, and Omni Financial Advisor, these are the three business verticals that Anand Rathi actually caters to. And in terms of their AUM breakup as well, if you see, equity mutual funds is the maximum, which has exposure of around 67%. Debt mutual fund is around 13%. And if you talk about SIP and others, that is close to around 18 to 19% in totality. Moving on, let's quickly now understand what are the kind of rating parameters that we are going to consider. First up, the income statement, balance sheet, the operational highlights as always, return ratios, shareholding patterns, street credentials, valuations, and guidance. These are the parameters that we are going to consider as well whilst doing a KYC on this counter. First up, let's look at the income statement. Now, the revenue growth, if you see on your screens as well, is absolutely strong. You're talking about a 3-year compounded growth of around 32 to 33%. The profit growth has been consistent. A 34% compounded growth is what you're looking at, and the margins have been absolutely stable. Now, the increasing operating leverage, because your expenses are rising, revenues are rising faster, the operating leverage for Anand Rathi Wealth is also positive. And that is what the key takeaway is on the income statement, and hence we've given it a thumbs up so far. Moving on, let's look at the second matrix, and on the back of this only, if you just look at the first or the second quarter numbers, on a sequential basis, a good growth that has come in there. You're talking about a 23% year-on-year growth on the revenue. The margins also are pretty strong. The profit number has seen a growth of around 32% this time around as well. So strong numbers coming in there, and you're talking of a 46-47% kind of a margin profile. And hence the question, how sustainable is those going to be from here on? So that's with regards to where the income statement goes. Moving on, let's look at the second parameter. We're talking about the balance sheet of the company. AUM, a 32 to 33% CAGR growth is what we've seen. Now, there has been growth in the assets and the equity of Anand Rathi. A moderate increase that has happened when you talk about the liabilities vis-a-vis the strong equity growth that you've seen for this company. Now, a sharp increase in the investments, in the long-term investments in FY25 as compared to almost 112 crores in FY24 indicates a strategic increase in investments or possibly deployment of surplus funds as well. And the strong growth from FY23 to 24, wherein the AUM jumped almost 50% from FY23 to that 59,000 crores. That's a big leap. From there, the growth has slowed somewhat around 30% because that increase has happened from around 59,000 odd crores to nearly 77,000 odd crores in FY25. But still, this is very healthy growth that we're talking about, though lower than the previous year's spike. And the continued strong momentum that we are seeing in terms of FY26 as well is interesting, because in the first quarter of FY26, the AUM has further grown to almost 87 to 88,000 crores, which is approximately 27% year-on-year growth relative to the same quarter in FY25. So the growth has continued, though it is not accelerating from here on. And hence, a thumbs up coming in on the balance sheet as well so far. Now, let's look at a few of the operational highlights. if you look at the managers, I mean, it's gone up from 293 to almost 380. The active client base has also increased for the company from 8,300 to it's gone up to 11,700. And your AUM per relationship manager has also seen a good growth of from 129 crores in FY23 to almost 198 crores. The clients per relationship manager has remained stable in that 29 to 31 kind of a range. But again, strong matrix coming in on the operational side, and hence a thumbs up given in on this parameter as well. Moving on, let's quickly look at all the return ratios of the company. Now, strong and improving returns is what we've seen in FY25. It's relatively stable, you could say that, because if you have to compare this in terms of FY23 to FY24, if you talk about all ratios, they have been absolutely high, which suggests that the company is actually generating substantial profit relative to the capital it uses in terms of the equity assets. And this is quite good, especially for the wealth or financial services space as well. It's actually suggesting the efficient use of equity and assets. In fact, if you talk about the revenue and PAT growth, which we took you through in the income statement, the company has seen strong revenue growth and profit growth in recent years, and more profit on a relatively stable equity base, which is what is inflating your return on equity. In fact, the company has shown very strong return ratios over the past 3 years, where FY25 actually stands out. Your ROE is in that 44-45% of range. Your return on capital employed is approximately 60%, and your ROA around 32 to 33%. And these are high relative to many of the peers. So the trend is upward or probably stable to upwards after a modest dip that the company actually saw from FY23 onwards to 24. And FY25 seems to have marked a breakout or a strong improvement in efficiency and returns as well. In fact, a good combination of high profitability, low financial risk, that is low debt, and efficient use of capital and assets is what you're seeing. Just because, they're plateauing at some extent, we've given it a neutral rating so far. Now, let's look at the shareholding pattern. Again, a neutral rating on this one, and the only reason being is your promoter stake shareholder has been declining. Your FIs also have remained slightly stable in that 4.8 to 4.9% kind of a range. Your DIIs, again, very stable at that aspect. So you're not seeing further FI or DII participation that is increasing here, and hence a neutral rating coming in on the shareholding pattern as well. Street credentials, again, are neutral because of the last 1 month performance. The stock is down 3%. If you talk about the last 6 months or YTD, it's that 50 to 67 kind of returns that we've seen from this counter. 5 years, again, it's a 940% return, but again, a neutral rating coming in there only for this short-term pain in the last 1 month. In fact, if you talk about valuations as well, let's look at that parameter. It appears priced for premium growth. Please mark, I'm talking about price for premium growth rather than value over here. The reason being is, if you have to compare Anand Rathi to a Prudent Corp or a Novama Wealth, it's the most expensive. The valuation multiples have constantly remained high as well for Anand Rathi Wealth. And though it's eased now slightly, it's still less frothy than the past peaks as well. And hence, you're talking about a downward reaction on this one, and hence a thumbs down when you talk about the valuations of the company from here on. Lastly, outlook. Now, they've guided for a revenue of 1,175 crores in FY26. This is versus a 980 that they achieved in FY25. And a profit number of 375 crores is what you're looking at. AUM at 1 lakh crore. So this is going to be interesting to watch out for from here on. Now, quickly, let's just do a summation of all the ratings so far. 3 thumbs up, income statement, balance sheet, operational highlights, neutral on return ratios. Shareholding, street credentials is a neutral. Your valuation is a thumbs down because it is expensive. And your guidance, again, is a thumbs up, which takes you to a 5.5 on 8, which is a very strong rating, again, on a know your company when you talk about Anand Rathi Wealth. Take this conversation forward. Feroze Azeez CEO joins in. Feroze, welcome to the show, and always a pleasure to speak to you. First up, you've already achieved more than 50% of your revenue and PAT guidance in the first half of FY26. One, sustenance from here on, and 2, Does this mean we could probably see a revision in terms of your guidance upwards?
Good afternoon. Good morning, in fact. Yes, we have penetrated 52% on PAT and 50% on revenue, a little over 50%. But do we revise the guidance? No, because we have been always taught to undercommit, over deliver. And I think half year is not good enough proxy for us to understand the full year. So we'll maintain the 375 crore PAT number and 1,175 crore revenue number and 1 lakh crore of AUM mark. AUM in Anand Rathi is counted very, very microscopically and not inflated. So that's we are at 91,568. The odds of this happening has gone up substantively. And sustenance, when it comes to sustenance, we have been indicating a 20-25% growth for a decade at least. But yeah, the believability of that will only come. This is only our 16th quarterly result. After we've got listed, I think 50 quarterly results will bring in more credibility to the statement of a decade of a growth.
Interesting point you made, Feroze, is that, the possibility of overshooting that 1 lakh crore mark in terms of AUM, there's a high possibility, but yes, you want to underpromise. That's what you're looking at right now. But if that is the scenario, what is the downside risk that you as a company would prepare for then?
See, downside risks could be several, but I think all of those risks which we understand because we have tried to build this business brick by brick. When you build a business brick by brick, you get time to correct yourself. Quite a few of our companions in the industry want to build it quickly, get private equity money, hire a lot of people, but you need for a company to do its mistakes. Since Mr. Raval joined in 2007 April, and now it's been the same. He's the longest standing large wealth management outfit CEO. And we've built it brick by brick. So we've corrected and tried to manage each risk. Now, when we speak of risks, most analysts, when we went IPO, said that you will lose market share because direct mutual funds will become very popular. But in 2019, my net flow market share was 0.16. In 2021, we became a listed company. Where today the market share is 2.36%, more than 10 times market share increase. So whatever risk we see, we try and mitigate them, and that happens if you evolve a company rather than just build it quickly.
Okay. And what about the margins? Again, 45, 46%, is that something which is sustainable? Or do you see pressure or tailwinds from here on if you have to consider cost structure or even scale for that matter?
Because we've built a very simple business, margin at a product level will not shrink because we try and make 14-15% for our clients and we like to make 1.2% for ourselves. And I think if we are able to deliver 13 to 15% return to our clients, which we have, after listing, our mark-to-market gain has crossed 27,000 crores, which is greater than the assets we had when we went listed. So when we make profits of 13 to 15%, will we be able to sustain 1 to 1.12% yield? I think for the next 10 years, we can sustain. But when it comes to margin as a percentage of the total revenue, which is 46% incidentally now, will shrink because we like to reinvest in our business to make sure that the sustenance of 20% growth for the next 10 years can easily be pocketed. So margin as a percentage of revenue could shrink because we want to reinvest in 3-4 different divisions to make our business so much more robuster than it is.
Okay. So when you're talking about different businesses in terms of penetration, what is going to be your client acquisition or retention strategy specifically with HNI or the ultra-HNI segment? And are you targeting new client demographies or even geographies to that matter, which will probably impact your margins to one extent? And then the segments that could then drive growth for you?
Yes, again, our business is reasonably simple. If I take care of the client, the hypothesis is HNI and ultra HNI are the smartest people in India. My client is the smartest person. If I do well for him, both on return and risk, and in turn risk-adjusted return, he takes care of me. So he gives me references. He gives me more wallet share from another competitor of mine. So I only have to have a soul-minded obsession to do good for him. then automatically I will do good. That's the hypothesis, because he's a smart guy. He's not just emotional person, right? He's going to be mathematical as well. So coming back, how will we grow our business? Because I have 12,700 families. If I do good for them, if I created a great Jensen's Alpha risk-adjusted return measure, they start giving us references. So that's where you would see a sharp rise in our acquisition and also in penetration. If you see one quarter as a proxy of penetration possibility in our business, in the quarter gone by, market sentiment has not been great, but our equity sourcing has doubled from 1,000 crores last year, same quarter, which was a great optimistic quarter. Last year, same time, we were very, very bullish. But this quarter, clients gave us more money. Why did they give us more money this quarter? Because you are giving them a risk adjusted return significantly better than your competitor. So to answer your
So,
pointed question, I have to take care of the client and the client takes care of me.
okay. In that scenario, how are you seeing the mix in terms of business vertical shift between private wealth, advisory, mutual funds, distribution, the B2B, the phygital? How does that evolve over time, number one? And two, of the growth that you've seen in AUM so far, what proportion are you expecting it to come from fresh net inflows versus the market appreciation?
I think there's so many questions intertwined into one. One is the B2B is a SaaS platform where there's, for a fee, we give our technology to independent financial advisor, which is called the OFA, Omni Financial Advisor platform, which is growing slowly. And that's a subscription model. The other digital wealth business is done very well. And we are still in the experimenting phase, and we are not looking at innovation in the digital. We are trying to see how you create how do you crack the code between a physical RM and digital and try and make it phygital. So we are still cracking that code, and the team is doing beautifully in that interim, point one. Then coming to what happens in terms of our projections because of geographical spreads and business verticals, I personally think that private wealth business, which is a flagship business, will continue to deliver that 25%, and that will remain the flagship business. The digital will help us understand how to extrapolate that to an HNI and augment the RM to become more powerful. Like that Popeye example, when he eats spinach, he becomes more powerful. Our entire technology is to empower the RM to be more efficient rather than replace the RM.
Okay, Feroze, my last question. Strong profits, cash generation is also strong. What is your capital allocation policy from here on? Is it going to be reinvestments, buybacks, dividends? And secondly, any plans for inorganic growth? How are you looking at that?
When it comes to our ROEs, they've been upwards of 40%. Now
Yeah.
it's about 44, 45. ROEs are high. We would like to keep our ROEs high. We would want to give dividends. That's why you would see on an expanded capital, we've given a 6 rupee dividend in the interim. So that's one. Buybacks we have done. I don't think buybacks will be too many. Bonus we gave. The last time we spoke of bonus, the price was very similar, 3,400, 3,500, and gave a bonus. We wanted to have more retail participation, but that got undone, fortunately or unfortunately. So bonus, we've always believed in rewarding the shareholder, and that should be on the cards, hopefully, if the board thinks it's wise to do.
Okay, so that's going to be interesting to watch out for, because return ratios, the moment they are high, investors are always happy. But thank you, Feroze, so much for joining us on the show. Always a pleasure to speak to you. That's all that we have, folks, on this edition of KYC, only on NDTV Profit for your profit. Please stay tuned for lots more.